Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I wanted to talk about Canadian banks today. They've been going down since the middle of March, as you can see from the Royal Bank and Bank of Nova Scotia charts. So why is this happening? Well, one of the reasons is the recent yield curve inversion, which is when the short-term government bonds have a higher yield than the longer-term government bonds. So this is what a normal yield curve looks like, with the shorter term bonds yielding less than the longer term. Think about it like term deposits. The longer the term deposit, the more it pays out because your money is locked up longer and there's a greater risk that something is going to go wrong. Bonds work exactly the same. The indicator of the short-term yield being higher is because there is a higher perceived risk and a higher inflation. But then as time goes on, the risk lessens and so does inflation. At least that is what the bond market is expecting. The US has had an inverted yield curve, and we have right now, as you can see, with the 20-year bond yielding more than the 30-year bond. So the question is, which terms need to be inverted? Some people say the 1 and the 10-year, others say the 2 and the 10-year for it to count as an inverted yield curve. The inverted yield curve affects Canadian banks in two possible ways. Number one, in the US, this is often an indicator of a recession, but with false positives. If there's a recession, there was an inverted yield curve 6 to 24 months before it, a large majority of the time. But an inverted yield curve can be a false positive and doesn't always indicate a recession in the US. In Canada, it's even less of an indicator of a recession. Recessions are bad for the economy, businesses, and definitely banks. A recession in the US would cause one in Canada, and we could have one in Canada independently as well. Banks would have less business in a recession, people would borrow less, and banks would get less revenues, and that is why the share prices are going down. Now, the second way that an inverted yield curve is causing problems for the banks is that banks get money into savings account on the short end of the yield curve, paying you interest on the low end of the curve, and they lend out your money at the rates on the long end of the yield curve. Those rates are pegged to the yield curve just as an industry standard, with the length of the mortgage indicating the government bond duration to use. If the short end of the yield curve is not as far from the long end of the yield curve in terms of interest, the banks will make less margin and profit. And they may lend less because it's less profitable, or only lend to their best customers, further reducing profits and also possibly helping to cause a recession by slowing down the economy by removing some of the liquidity. And so that is why banks are going down in share price. There's an expectation of a recession and a possible reduction in bank profit margins. This should be a temporary issue and will resolve itself as the inflation and risk go away. So if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.